So today is our free Friday preview, market outlook preview at marketscholars.com. Today you get access to our full market outlook video rather than just the short 5-minute preview that you typically get throughout the rest of the week. This kind of gives you an idea of what's in the video. You also get access to our blog post for free for the weekend, which is free normally as well. You just have to subscribe to the site for free to get it, but it's free, available for everybody, so you can kind of get an idea of what you can subscribe and get access to that so many others have subscribed to in our community, in our Market Scholars community. It was an interesting week this week with the rate decision, the Fed's rate decision, how it impacted the markets. China TikTok deal was in the news today. You had Nvidia making deals with Intel, and earlier in the week, crude oil had a significant move, quadruple witching. All of that was on the plate today. So it ended up making for a very interesting Friday, very interesting technical pattern too, going into an expiration. I'm going to break that down. I'm also going to break down quite extensively today this idea of, do we want everything to be going up? So pay attention to that in the video as well. And then our trade idea. You'll get access to our trade idea of the day today, which is on a financial company that's got a little AI component to it. That's also has a really good pattern itself on its chart. So we'll take a look at a trade on that. So let's go ahead and get started. Today is Friday, September 19th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Really quickly, you can subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment down there and anything that stood out to you today, share it with others. Join our website at marketscholars.com for free. You can email me as well. You can see our addresses up there. Follow me on Twitter for more content between the videos at DavidSettle42, and join our Market Outlook Facebook group that we've created. If you're watching here on our blog post, remember today is Free Friday, like I said before, and you get access to this blog post. Again, this is available to everybody every day of the week for free. So the video, the full version of the video, is available for our foundation members, all of our subscribers, including our foundation members. But the blog post here is available for everybody for free, including our Market Outlook preview video during the rest of the week. All you have to do when you go to our website at Market Scholars, first of all, the link to today's blog post is right up here. If you're watching us on YouTube, click on that link. It will take you to our today's blog post, so you can check that out. For the rest of the week, all you have to do is just go to our website, go to Market Scholars, hit Market Scholars Archives, click on the video you want to, the post that you want to see. You can see they're all listed here. It will come up with this page. All you have to do is click on that button, and that will subscribe you to our site. If you click here, that link will also take you to the same page where you can subscribe to our site there. This is what the page looks like right here. So again, just that link takes you to this page, and just click join free now. And then, like I said, you can get access to all of our daily Market Outlook blog posts as well as the preview videos. And again, a full version of our video is available for all of our foundation members. You'll see that here right there. So just click on that link. It takes you to this page, and you'll see that right there as well. Click on that link, and that will take you to this page and learn more about our foundation tier level. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator closing at the highs of this period, right? So we started the expiration cycle with a little bit of a decline, a near-term decline. And we had two near-term declines during this expiration cycle. Again, we've gone now at 1, 2, 3, 4, pretty much 5 expiration cycles now that we've been on this rally that we've been on. So, this expiration cycle we started it with a near-term decline. We had one in the middle. The last expiration cycle, we only had the one near-term decline on August the 1st, pretty much 1 day decline. The cycle before that, we started the expiration cycle coming off a near-term low, and then we only had really, you had a little one there, but really just the one right here at the end, right before the end. Of course, this one we had two, one at the beginning, one at the end, and then one before that. Again, you're coming off of a near-term low to start the cycle, and we had one near-term decline in the midst. So again, we've had 1 to 2 near-term declines, and we've gone, like I said, five cycles now without a intermediate decline. And again, we've gone quite a bit of time here without a near-term, like it was in the middle the stage, and you kind of get an idea of how long it takes in between, right? In between cycles here. So, are we, how long? I mean, shoot, since the last one, we're up, how many days has this been since the last near-term low point? We're, what, um, 14, 13 sessions off of the low. So 14, including the low. So 13 days, bars off the low. So 17 days total, including the weekend. So almost 3 weeks. Like, it's 7 to 12 days is your typical time frame. So we are, like I said, 13. We're past the long end. So most likely, like, we'll probably start off like we, this next cycle, like we did this one, right? We close at the highs of the cycle. We'll probably start off with a near-term decline coming into it, right? We had a long near-term rally. See, this one we ended with a near-term decline. This one we ended with a near-term decline. This one we had, a good, pretty decent rally, and so we had our near-term decline early. And then this one we ended with a near-term decline. So if you don't end with a near-term decline, it appears that we, especially if we've been on a near-term rally for a while, it appears that we'll probably start the next cycle with a near-term decline. So was a near-term decline look like? It's just a dip on the blue line into bearish territory. You notice, like this, the intermediate line, it falls every time, but none of them fell out of bullish territory. Like, we had a couple near-term declines that brought the intermediate line below 80. Every other near-term decline brought the intermediate line down below 90, essentially. And we'll see what happens. We'll probably bring it below 90 this go around, would be my guess. It's hard to get. I mean, this one brought it below 90 and 80, same thing here, but my guess is it'll probably just drop us below 90 because we're not very far. We're only 2.68% away from the 30-day moving average. So we'll probably get a 1 to 2% decline over a matter of, 2, 3, 4 days, kind of like this near-term decline on the last cycle. So that's my guess going into the next cycle here as we close this one at a high point. If you look at the NASDAQ 100, you can see same thing. We're still on a pretty good, closing near the high of the expiration cycle, new all-time high. No cluster, thank goodness, right? No cluster there. The Russell 2000 also, I told you yesterday that when you have a big move, it's hard to build on it, and a lot of times we come down the next day or the next little bit, next few days. And so that appears to be the case. Like, we had a good move, and now we have a little bit of a decline, 0.75%. I wouldn't be surprised if, here we've had plenty of near-term declines. So, this is a lot more volatile. The short-term sentiment lines are a lot more volatile, and the Russell's a higher beta index. But same thing. If the S&P is going to go in a near-term decline, I expect this one would as well. And then finally, looking at your Dow Jones Industrial Average, same idea. Now, when I look at the market forecast for the S&P on a weekly chart, since this is a Friday, we did not get a new cluster, even though we had a high, we got a pretty good high here, a much higher high. We did not get a cluster. The near-term line did get, up to 95th percentile, but the momentum line dropped. So, we did have a little bit of a lower shadow, and, we didn't open and then go up to the, we didn't open near the low and close near the high. That's when you tend to get, good moves on the momentum line, especially if it's a good range, right? So we did have a low point, so that's what brings the momentum line down there. We are in the 94th percentile of the past 5 years. We are 11% above the 30-day moving average, so we're getting green dots, and that's in the past typically led to some weakness. Now we got a few more, especially with the cluster, and we got a few more. Remember the cluster and the green dot, like, the last time we had that was right here. We did go a few more weeks to the upside, just like this week. But don't be surprised if we're getting pretty close to a 5% decline. Again, that's nothing more than just a 5% decline. Like, again, we can drop down to moving averages, as you saw. We can drop down to the 50-day moving average and with a 5% move, a little bit below it, and still just be a 5% move. And I fully expect something like that. Not next week, most likely not next week. It will take multiple weeks to do that. You can see this took 3 weeks. This one took 4 weeks. And, these intermediate declines that are just kind of shallow, this one took 4 weeks. It takes multiple weeks. So it's not just a 1 week phenomenon. But I don't even think like next week will be the first week. I still think, we still need to see, we need to see on this other weekly chart that we like to look at, a lower Hakinyashi close. You know, and that's, you know, this way a clearly higher Hakinyasha close, a higher high. We close 40 points above the Hakinyasha close, so we're set up for a pretty decently bullish candle because the open's going to be around 65.50. So we're going to have about 100 points of a body. So we'll have. I mean, I don't know if we'll drop below the purple line, but we'll have another decently sized body to start the week, assuming we don't gap down significantly, which would be very low probability. So next week's probably not going to be the week. It'll probably at the very earliest, would be the week after. So kind of maybe the second week. Like I said, that doesn't mean we won't have a 1 or 2% decline, right? I just don't think we'll have the full 5% plus or minus decline, you know, multi-week span. Like we can go down a few days and bring the near-term line down without bringing the intermediate line down, which is what an intermediate decline, you know, which is what would happen during that 5% decline. Let's take a look at the other weekly chart we like to look at, which is the hull, which is another reason why I'm not too concerned. You can see the, you know, the hull right now, 640.91 is where the, you know, we're 20 points above the parabolic SAR now. And remember, we don't get an intermediate decline until you close below the 20-week. The 20-week turns red. So you have to be below it for multiple weeks for that to happen. And we're a few points above it right now. So you have to close below it enough to turn it red, and then you have to flip that parabolic SAR. And that's not happening next week either. Neither one of those two things is happening next week. So again, the earliest would be the week after, but definitely not next week. But at least, again, nothing's 100%, but I would say pretty high probability that we still, you know, maybe a 1 or 2 day decline, you know, maybe a few days where we get that near-term line down, nothing more than that. All right, let's take a look at the 3 green arrow chart. Obviously, on the weekly chart, we are 3 green arrows like, you know, nobody's business. And in fact, even the MACD histogram, which had been coming down, is turning back up the last couple of weeks. So that's a, you know, good sign there. You know, it's probably going to be temporary, but still, it's a good sign nonetheless for us to be turning up higher. But if I take a look at the 3 green arrow charts on the daily, then you can see that we are, you know, doing just fine. 3 green arrows across the board. We're nowhere close to 3 reds. The stochastics, you know, both of these two are way high. So, and we're well above the moving averages. We're nowhere close to even a single red arrow, much less 3 of them. Let's take a look at the DMI. So we are still above, even with the decline, we're still above 30 on the positive indicator. We're still below 20 on the negative. So your ADX is still rising. It's almost above 25. So that's a good sign for the markets. If I look at the RSI and the CCI, you know, you're back up to above 70 on the RSI. So that's a good sign. You're, you know, still above 100 on the CCI. So both indicators still very strongly bullish levels. This needs to go one more. And does this need to go one? No, it doesn't. So still strongly bullish levels on both of these indicators. So nothing's even close to being bearish. But we are, again, very overbought, right? That's the RSI. Is rare for the RSI to get above 70. So it's clearly overbought there. The Ichimoku cloud is still higher. It's not above 20, but it's above 19. It's not above 20 yet. You know, so I mean, strongly bullish. The cloud's really skinny, a little bit of, you know, expanding a little bit, but still pretty skinny there. The rate of change clearly positive. So nothing imminent at all in terms of weakness. If I take a look at the Bollinger Bands, we are in the upper quartile. We're not above the upper band, but we are above the upper Keltner channel still. And the bands themselves, the band width is coming down slightly, but not enough to bring the momentum down yet. So you still got positive momentum here still, that it's still slowly increasing to the upside. If I take a look at the intraday chart, we did not get a new high, but we closed near it, right? We closed near so we're a lot closer. The new low change, so we popped up from, you know, the low on the 21st to the low on the 2nd now is our new 4-week low point. And that will be the new. So here's, remember, this is day 0 for the Arun indicator. So day 1's right here. That's today, Monday, Tuesday, Wednesday, Thursday, Friday. So all next week, this will be the low point, unless we get a new one, which is doubtful. This will be the low point for all next week. So, you know, again, when we've gotten these pops above 30 on the negative indicator without getting all the way to 100, that's been pretty bullish. And I expect, now there's always been a little bit of softness after, and so I expect we'll get some softness, but I don't expect it to end the intermediate run that we're on right now. The range today was back to being, well, it ended up being relatively strong by the time the day was over. Earlier this morning, it was still pretty light and above average on the volume again, 3 straight days of above average volume. So that actually helps. The ATR was down to 0.73. Still, it's still extreme at 0.75, below 0.8, but not as bad as what we were this morning. And you can see that volume. Look at that volume rising. Again, it usually rises when we're bearish. All right, it's very rare for it to rise because we're moving higher, right? You can see over here it kind of did that, even all the way up to about that point, and then started to pull back. And so as a result, that's had a positive impact on the money flow. The money flow is back up. It's not extreme, but it's back up to pretty decently strong levels itself. Clearly bullish after a little dip below below. We're clearly bullish again, and again, we're not back up to this peak on the money flow, so we're not quite where we want to be. Even though price is well above that level, the money flow is not. But at least the index down here at the bottom, that's an oscillator. They turned this into an oscillator. At least it is at decently strong levels. If I take a look at the VIX, right? We take a look at the VIX there. It closed at the lows of the day today. After a pop there, you can see is actually early. This morning we popped up, gapped down, and popped up, but then we closed low. We closed below the 0.85%. The VVIX did not close, so we still have a correlation that's positive, but not as strongly positive as it has been in the past. Again, you can see the divergence there. The VVIX continues higher while the VIX itself stays low. So usually that, the VVIX moves in front of the VIX, ahead of the VIX. So if the VVIX is rising, as we've seen with these higher highs and higher lows, you would expect at some point the VIX will pop. Now I don't think it'll pop to 50 or 40 or even 20 for that matter. But can we pop into the high teens? Sure. Can we get back to 17, 18, similar to what we saw over here? Which, this pop right here came after this divergence we had in late August, right, where we dropped all the way down to 0.25% positive correlation. Right, and that preceded that pop up to the late teens. So I can see something like that occurring again soon. Now, will that occur during a near-term decline? Very much could, right? So, if I get an intermediate decline, we're going to pop above 100% right here. We're going to pop above 20 most likely. So just, near-term declines, you just get these pops into the high teens based off of currently where we're at right now. And that's what I see next week, and nothing more than that. And you can see when we get these pops, it's really good because volatility then drops pretty steadily after that. Now let's go ahead and talk about what's driving the price action. Of course, we're still kind of in the aftermath of the FOMC rate decision, though we did have a few other things that impacted the markets here today. Like the TikTok deal, supposedly, that's being made between the U.S. and China. Apparently that's on the table, helping out the XLC segment of the markets. Energy struggled with the drop in, you can see commodity prices were down. Lower demand, like lower inventories here recently for crude oil, has put some pressure on it. If you take a look at the 1-year chart, you're breaking back down below moving averages, breaking back down below the value area the past year. This is a downturn. Now, that's not a bad thing. As long as we don't break down hard. If we break down hard because there are serious issues about economic growth expectations, then that's going to be a sign, right? You'll probably see yields drop down along with them. So if yields and crude oil are both dropping hard, then that's a bearish sign for the markets. If crude oil is dropping, but yields continue to rise, breaking above the 8 yesterday or a couple days ago, on the day of the rate decision, now breaking above the 17. It's not breaking out. We're going to probably hit up against some resistance, probably say around 4.25%, maybe 4.2 in that area. We're up to 4.14, right? and that's 14 basis points off the low when we were just barely below 4%, about 15 basis points off of that, the actual low. So it's yields are rising. They're not going to take off. We're not going to have this kind of move. I don't think we get back above the 200-day moving average. The problem with yields is that look how close we are to getting below the 200-week moving average. We continue to get progressively closer and closer, and again, breaking below the 200-week moving average on yields is not a good thing. and the yields continue to rise. Like right now we're at 3.65%. Remember the FOMC is set based off the futures market and really based off of what Powell said this week. They're pretty much set on dropping rates 2 more times, so down to 3.5 to 3.75% would be the new range. Well, that's where the 200-day moving average is. So as long as we fall down to that, see last year the 10-year yield actually rose to where the Fed stopped cutting rates then, right? So because they only cut rates by 100 basis points. Remember, we started out that cutting cycle at 5.25%. So we ended up at 4.25% by the end of the year. And so over here, sorry, this is 2024. So we basically rose to the level that the Fed cut rates to. There, we were so far below that the 10-year yield going into that move. So that's obviously not the case right now. So we're not going to take off. This is actually the move right here. We're not going to take off like this, like we did last year, to a really strong move higher, because we're not in the same scenario. We're not very far below. In fact, now the Fed, currently we're right in the middle of the current range. So again, it makes you think, like, if we do break up above these moving averages, which I don't think we will, but if we do over the next few weeks and we have this kind of move like we did last year, then the Fed won't cut rates again the rest of the year. But that's unlikely, right? The Fed's very likely to cut rates, and the bond market knows it. So we'll most likely will stay in this area. 4.25% will be the high point of the range, and then this 3.5%, 3.65, will be the low end of the range, right? That will be, or 3.5, a little bit below that maybe. That will be the low end of the range. If we start to break that, especially with falling commodities, then we're in trouble, right? You can see commodities are in a bear market, have been in the bear market, but we're in trouble at that point because, again, economic growth expectations are pretty much synonymous with demand for commodities, and that's bullish for commodities. If there's not demand for commodities right now, especially for crude oil, as you can see, commodities aren't as bad as crude oil is, because of there's other commodities that are doing okay. Gold especially has been doing so well. But crude oil is, that and for silver, as well as an industrial metal. I mean, you can see, so there are some, industrial type commodities, copper, another one, right, that that are, still like above moving averages and they're still fine. But if they were all start to falter along with crude, and again, yields fell too, that would be so that's our kind of what we're going to be watching for. Like I said, demand for crude this week was really, really minimal. The other thing too, I mean, obviously it was quadruple witching. So we talked about before on a technical basis, that had the biggest impact. That had some impact on some volatility for the markets today, but really nothing more than that. You can see gold is up pretty well, even though the dollar was up today. Gold still stayed, and commodities were down, but gold really rallied. And again, it's kind of gold is the ultimate, like, we don't, is the ultimate way for the market to say we don't like what the policies are, whether it's monetary, fiscal, or combination of both. Gold is the ultimate. I mean, especially with the dollar rallying, is the ultimate there. And this is, if I were to zoom out to the week that was now, you can see, small cap stocks hit a new all-time high. In fact, if I were to take a look at the chart here for, let's do this. Let's go to the asset class comparison chart. I'm going to go back to this chart here. And let's change this back to November the 8th was the last time in 2021 that the Russell 2000 hit an all-time high. Before this week we have now eclipsed that for the first time. So now we're Russell 2000. The small cap index is up 0.5% right now. 0.5% there. So finally, and you can see, in that same time, it's taken almost 4 years for the Russell 2000 to finally get back to, and you can see it kind of retested the high right there too in November of last year. But in the time that it's taken for it to get to a new all-time high again, an all-time closing high on the Russell, the Qs are up 50%, just absolutely killing it. But look at the chart here for the 10-year yield. I thought this was fascinating. Look at the 10-year yield chart for crude oil back in November of 2021. It's right in this area, right there. So we were at 1.5%. Actually, on November the 8th. Here, let me switch to a daily chart. We were below the 200-week moving average on that day, but right here, this was the day, right here, November the 8th. That's the day that the Russell peaked. The 10-year yield was at 1.5%. The 10-year yield was at 1.5%. From that point going forward, we are finally reaching a new all-time high on the Russell again, and the yields are now up 4%. So that's one of the biggest reasons why, and the Russell 2000 would really love yields to fall. But again, remember, when the Russell 2000 outperforms the S&P, that's usually not bullish. That's usually synonymous with the RSP outpacing SPY. So the equal weighted, because really, like, the bottom of the S&P right now look like small cap stocks compared to the upper end. Because we're so concentrated, we're so bifurcated. But you can see this is highly correlated with the markets. And so, if I were to go back 20 years or go back as far as RSP has been in existence, you can see, like, in 2022, like, we didn't want RSP, we didn't want RSP to outperform the S&P. Like, the S&P dropped versus RSP. Same thing here in 2008 during that correction. It bounced up pretty quickly because, again, during the washout phase of the bear market, things really hit the fan there and everything dropped, right? The RSP stocks finally fell down too. Everything fell during that washout phase. But this is where it's at now. And, again, we don't necessarily want this to start to roll over. Right now, we're kind of going parabolic here. It's on the daily chart. You can see how high we are above these moving averages. The PPO is up at a pretty decently high level. The intermediate PPO, the CCI is high. The DMI, the look at both these directional indexes are both pretty high. And then the RSI is up pretty high too. And you can see again the correlation, at 80%. So we don't necessarily want that. We want the S&P to continue to outperform just like it's done since the last correction low that we had in October. A little bit more of a dip there at the beginning of the year, but really especially since the regional banking crisis put pressure on the small cap index, this thing has taken off to the upside. So if we were to start to peak and roll over again, it would be another sign of weakness. Again, we want everything, like strong markets, everything goes up during strong markets. Weak markets, you have rotations, right? But strong markets aren't mature markets, right? Mature, like stocks, intermediate rallies start off strong because when everything falls, when the S&P falls, everything falls. And then so when the S&P bounces, everything bounces. So that's the strongest time. That's usually when you get the strongest momentum move. Your MACD is peaks. Peaks. You can see, look at the MACD peaks after coming off of a low point. You see the MACD peaks, the highest level of the MACD during this entire correction from this correction within a pullback range, this drop from that low to this high point. The highest momentum move was the very first one. From this low point so far on, the highest momentum move was the first one. Right, you can see the histogram there, coming off of this low point here. Again, the highest momentum move all the way up into this peak, the highest momentum move was the first one, right? This first rally off the low point. That's how markets behave, even on intermediate levels, right? When we come off these intermediate lows, the highest momentum move, the PPO, was highest during the move off the low point, right? It was, you had other peaks that came close, but they got progressively smaller as you went. The markets get weaker as you go. They have their strongest moves early. Everything rallies off of lows. And that's when, again, everything is going up. But if everything starts going up again, or if the small cap index starts to outperform here late, and everything starts to go up again, that usually, like we saw that right here, and that usually happens. We saw that over here too before that November peak, right here. This is where right here you also had a big strong move in the S&P. The Russell peaked on November the 8th. Everything was going up, and then we ended up having a huge correction. So we don't want, during a bullish move to have everything go up, right? That's a sign that the market's actually weakening, not strengthening, right? Like, because we get that confused. We think, okay, yeah, the markets are strongest when everything goes up. Well, yeah, because the market's always strongest when you're coming off of a low point. And everything is, I mean, you see that. There's visual evidence of that. The highest PPO during any bullish rally is the first peak, right? Remember, this measures momentum. That's when the market's the strongest. And everything is going up during that period of time. So that's why we think, okay, well then if the markets are going to always be strong, then we always want everything to go up. No, that's only when you're starting these bullish moves. Then we can rotate, right? We can rotate back and forth, right? And that's where this relative rotation graph comes in. Let me show you the relative rotation graph over here. And then let's take a look at, let's see here. Let's take a look at the sector ETFs. And let's just go back let's go back 3 years on this. And you can see on a daily chart, we'll go to a daily chart. So let's go back to when we first came off of, we'll go max here. When we first came off of the low point here, you can see, okay, technology did very well coming off the low. XLC was in there. You can see all these other smaller sectors all in the red category. Now, as they did rotate up and over briefly there in the improving category, and XLK was down. Then we started to go up again. Energy and technology were everything else was moving down to the left. And then they rotated up. You see the rotations. So there's some rotation here. All these other small sectors doing well. The bigger sectors rotating down to the left. But then they all started moving down. It's like, so during an intermediate run, like there's rotation, right? There's rotation. But when we first come off the lows, everything tends to go up. On an absolute basis, everything goes up. In fact, if you look at it here, let's go to this sector comparison chart here, and then we'll wrap it up with this. And let's go back to when we came off of the April 8th low point, April 8th, and we'll go to a daily chart. So, and let's actually go to the night. So the low was on the 8th. So let's go to the next day here. So on the next day, you can see by the time we rallied up, off of that low point and we were up about 10, 15%, everything was up, right? Now, healthcare wasn't doing as well, but even staples and utilities were up like 5 to 10%. Everything was rallying. Industrials, financials, materials. I mean, they were all right there along with discretionary communication services. Now that's not the case, right? Now you can see over here, they were pretty much all right on top. Industrials is actually doing really well, and technology was the big winner as we expected. It's got the 3 biggest dogs in it, so it should be the big winner. But you can see now from that point going forward, now you only have these 3, and there's a huge now industrials is not outpacing. And then financials and materials, which were sitting right there with them, are now lagging significantly. And utilities and real estate, which were only barely lagging, are now significantly lagging, those 3 areas. Because as the market goes up, you start to get rotation. Sometimes these do well, they did well there, then they pulled back, and then they did well again, and now they're pulling back because you rotate through there. But at the beginning, everything goes up. So that creates the fallacy that we always want everything to go up because that's the strongest market. Nope. We got a pretty strong market right now. And it's not the case. In fact, you look at today alone or this week alone, so the week of this rate cut where, IWM did pretty well. Look at the only 2 sectors that outpaced the market this week. Let's go to a 5. Look at the only 2 sectors that outpaced the market, and really 3 when you look at discretionary. On the week that the Fed cut rates and IWM did so well, look at the 3 sectors on the S&P that did so well. Now, industrials and financials, they didn't lag by very much, but everything else, look at everything else. All your safety trades, materials, they were all negative on the week, even though the Fed cut rates. So we don't want this fallacy of everything going up. We want XLK to keep going up. And as long as XLK keeps going up and it continues just to kick butt, right? That's what we want. That's the most healthy and most bullish market right now, simply because that is that's the biggest sector in the economy. Look at that daily chart. That looks great. Well, after flirting with breaking below these averages just a few weeks ago, now not so much. Big time move up. The ratios are easily back above its 50-day, and you can see both lines above 100 and rising. Perfect, right? If I look at the weekly version for this chart, well above. Let's zoom out so we get some context. Both lines still above 100, well above the 50-week moving average for the ratio. near its highs, and then you can see big time move. We're nowhere near closing below the 17-week. So we're doing very, very well. If I look at it, XLK relative, so we kind of saw the 50-day moving average here, but if I look at this relative to SPY, here's the ratio chart, and you can see it's near its highs. The correlation has been dropping a little bit, still positive, but you were starting to get some, you can see the long-term average is, the PPO, long-term PPO is rising. The CCI is back to bullish levels. The RSI is back to bullish levels. Everything is, PPO is back to bullish levels. Everything is back to exactly what we want to on the ratio chart of XLK relative to SPY. We break down below the 50, we break down below the 200, and now we're in a little bit of trouble. We don't want that ratio to be down below these averages. You can see earlier this year, that was when we were the most bearish during that correction there. And going into the correction, it set us up for that weakness at the beginning of the year. All right, so that brings us to our trade idea of the day, which is actually not in the technology sector. It's in the financial sector. It's an insurer, but it's associated with AI and technology, and that's Lemonade. Lemonade has had a really good run here during the past so many months. A little bit of a pullback here in early September. Got a bull tag about a week ago, but bouncing up and finishing the expiration cycle really strong. Nice, good move to the upside. So, again, we had a near-term decline during that cycle. We had a near-term decline during this cycle, and, an opportunity to really take off here. As you can see, if I look at the weekly version of the weekly chart here, we had a little bit of a pullback to the 10-week, but now we're rising. The PPO is high, but it's not the highest. It's only 71st percentile, and it's starting to rise. So you have an opportunity for some bullishness on the stock from a 3 green arrow standpoint. We're back to 3 greens. In fact, the weekly charts itself never did. I guess we had 2 reds, but it's been back to 3 greens as well, getting up to new highs. Working its way back up towards where we were in 2021. If I take a look at the 2-line version of this chart, you can see that we are breaking, the 8 and 17 day are breaking back above the 30. The MACD is positive or above the value area. The stochastics is positive. Pretty good volume on today's move as well. Looking at the DMI, you had a nice little breakout pattern here. Back above 30 on the positive indicator, below 20 in the negative. The ADX is just starting to rise above 20. So again, it looks like the trend, if we're going to get a trend, the trend, according to these indicators, the trend is just kind of getting started right now. If you look at the RSI, it's back above bullish levels. The CCI is at bullish levels. The Ichimoku cloud we had lost the trend on the Ichimoku cloud. It's now flirting with being weak, starting a new trend. Because remember, the trend starts on this indicator down here, getting above 15, above 1 on these two. So we're above both midpoints. The rate of change is positive. The cloud's still green. They're both rising. So very good bullish pattern there. And then, of course, today finishing above the upper Bollinger Band. After this squeeze play where the Bollinger Bandwidth really fell down close to 150-day lows. We got above the upper band. We got above the upper Keltner channel. Again, similar to what we saw over here. So we have an opportunity to rally for a little bit. So what I decided to do on this trade was to sell that low 30s delta. So sell the 70 strike, buy the 65. That gives me a long vertical spread with a little bit of flexibility for timing. Position sizing again, like we normally do, around $500 and getting almost a 3-to-1 reward to risk ratio. Like I said, with some flexibility for timing on that. And there's our trade for today. All right, well, that wraps up our free Friday preview. So thank you very much for watching. And remember, this is what all of our subscribers get every day of the week, including that trade idea for just $29 a month. So about $1.40 a video is all it costs. You get access to the full video. You get access to the trades that we do. You also get access to the Market Outlook Live. That's when we put the trades on in real time. And then we track the results of all those trades. And we also manage existing trades, which, again, I feel is far more important than just giving you a trade idea. Is actually discussing, okay, when do we get out? And why? And how? And when? And then we track the results of all the trades. You get access to that as well. All of that for just $29 a month. So you can subscribe to our site for our foundation tier. There's a link right there that takes you to our foundation tier, and that gives you access to that. It's on a month-to-month basis. You can cancel at any time. That's the beauty of that. But you get 2 months for free if you sign up for the foundation on a yearly basis. So that's a benefit too. It's a pretty good value considering that, the market outlook trades, have made, close to like $10,000 over the course of the year, just by themselves. We had a pretty good in a September expiration cycle. We had quite a few trades closing at maximum gain that we put on in prior videos. So it definitely more than pays for itself. In fact, a lot of people, a lot of clients, say that they make enough from the market outlook trades alone on their own. And I don't know what risk management they're using, but they make enough from the market outlook trades on their own to cover the cost of their premium subscriptions to our website. So again, that's it's available for all of you. Again, thank you very much for watching. Remember to subscribe to our YouTube channel and get a thumbs up today's video. Share it with anybody else. Hit the bell on that so you know when the preview videos are posted there. Follow me on Twitter for more content between the videos at DavidSettle42. You can also follow me on LinkedIn, Facebook. Like our content on those platforms. Helps get our content out to all of our followers. Thank you very much for watching. Have a great rest of your weekend, everybody, and we'll see you all on Monday.